back. You are listening to TurboCharge Your Business on the number one global business talk and news network on the internet, IBGR, International Business Growth Radio. I'm Patty Lawrence, and this is episode 30, Accounting Fundamentals, the Balance Sheet. Be sure to go to our website at ibgr.network and download the show notes. So, what is the balance sheet? We talked a little bit about that on our last segment when we talked about the chart of accounts. Well, the balance sheet is, I would say, the most critical of your financial statement. So it's one of the financial statements that is of the basic three, right? You get the big three financial statements. You've got your balance sheet, you've got your income statement, sometimes called your P&L, profit and loss statement, and you've also got your statement of cash flows, otherwise called cash flow report, cash flow statement, whatever you want to call it. So those are the big three. And the reason I think the balance sheet is the most important is because that report has been with you since you founded your business. Since you put $1 into your business. So say you started your business with, the $500 you had in your pocket, right? You opened up your checking account. Well, in accounting land, we would have recorded that as cash in the bank of $500, right, in your checking account, and the offset, because we have do double entry bookkeeping here. I know I'm getting geeking out on you, but the other side of that entry is, guess what? It's your equity, right? It's what you put into the business. So you started out with, $500 of equity. If you wrote a check into your account out of your pocket, that was your first transaction into the business, and that is your equity. And all of that is on the balance sheet, right? There's no profit, there's no loss associated with that. You're just opening your accounts, you're opening your business, you're starting out. So, what is a balance sheet? Balance sheet is your cumulative, the only thing that's cumulative in your business. Since inception, all of those accounts are what has happened since put your shingle out for business and put $1 into the business. So, what kinds of accounts are on the balance sheet? Well, in our chart of accounts, when we set up our chart of accounts, we have a few different sections. So the big sections that I talked about in the last segment were assets, liabilities, and equity. So assets are what you own, OWN. Liabilities are what you owe, OWE. And equity is basically the difference, right? Basically, the difference between assets minus liability equals your equity. So hopefully it's a positive number, because you don't want to owe more than you own. You never want to be in that position, because you need a turnaround expert at that point. You're underwater, and it's not a good situation to be in. So when we look at the balance sheet, we're looking at assets, liabilities, equity. So how can we break that down? So when we look at reporting, looking at our asset category, what rolls up into that category? Well, we have two distinct areas. We have current assets and non-current assets. Current assets have a liquidity to them, and you can get at them. They're I'll call it less than a year of maturity. Okay, so cash, very liquid. You can get at it very quickly. Things like accounts receivable, inventories, maybe prepaid expenses that are for 1 year or less. Those are current. When we look at non-current assets, think about fixed assets in your business and long-term type over 12 months maturities or things like that. So if you have maybe like a CD or something like that, in investments, maybe property, fixed assets. So you look at property, plant, and equipment, office fixtures, office furniture. Computers, we can talk about that later. But oh, if you bought a business, you might have a goodwill. Goodwill is an intangible asset and may be your tax professional has put that on your balance sheet as an asset. That would be in a non-current asset category. And then there's other non-current assets that appear on that on your statement as well. They're less common in smaller sized businesses, but they can occur, especially when you have you've bought businesses, acquired businesses over time, or acquired let's say customer lists or phone numbers or any of those types of things. You'll have those sitting out there in non-current assets because they're longer term type investment activity. So when we look at cash equivalents meaning like undeposited checks and some of those type money market, or if you have some investment activity like that, those would be in your current assets because those are very highly liquid. Liquid meaning you can get at them and change them into cash, spendable cash very quickly. Same with accounts receivable. And accounts receivable, they're kind of a special thing. That's a preview. I call it a preview of coming attractions. That's basically sales that you have not yet collected for. So if you have accounts receivable, it's because you have given payment terms to your customers. So your customers and clients are out there, and maybe you give them net 10 days, net 30 days, or they request to have terms from you. So that's okay as long as you're managing those. So there's an art and a science to managing accounts receivable because you don't want them to age. Aged accounts receivable are harder to collect. So keep those things current and keep on top of them. Another current asset is inventory. So if your business is a product based business, then you might have inventory. You might have inventory, you bring it in, you have terms with your vendors, and we'll talk about that on the liability side. And then you are able to buy now, pay later. And you need to manage inventory similar to managing your accounts receivable because unlike a fine wine, inventory, typically business inventories, do not age well. Okay, the longer you have them in inventory, the dustier they get, and maybe the more obsolete they get. So keep an eye on that. Let's look at liabilities for a moment. So, in the liability category, again, we have the current and the non current. So, current is 1 year or less. So, basically, think about vendor payables, anything in accounts payable would be in that category. Things that are in the non or thing that are in non-current are maybe a debt like a mortgage, or a vehicle loan, automobile loan, some of those types of things. They would show up in your non-current because those maybe are financed into 3 to 5 to 10 years. So you would have a portion of that in your longer term or non-current liabilities. Now, your equity section breaks down in a couple of different ways. You have paid in capital. And remember, I started out by talking about you opened your business with your equity. So you wrote a check into the business and opened up your checking account with $500. So paid in capital, that's you. You paid into the business and may have made similar payments over time. That kind of payment is capital. It's your equity. Then you have retained earnings. Retained earnings are just what they say, earnings that have been retained into the business over time. So at the end of the year, what your P&L shows, say you made $100,000 on your bottom line. Woo, that's a celebration. Well, that P&L amount gets closed out into your retained earnings account. And it's quote retained. Think about retaining those earnings in the business. Okay. And over time, remember your balance sheet is cumulative. So every year that gets closed into that account and um and it just keeps accumulating over time. So since the inception of your business, that's going to just keep building. And then you have other items if you're um, doing some bigger things in your company, maybe some owner distributions or some other, yeah, probably more complex things. But for our size companies, we would look at maybe owner distributions. Those would be a reduction of your equity. It doesn't affect your P&L, right? But your P&L, your operating performance, your operating income needs to support those types of things. And we'll talk a little bit more about that when we talk about cash flow. So, right now, we're going to take a short 2-minute break. And when we return, we will be talking about accounting fundamentals and the income statement. Check out my collection of free resources at turboexecs.com/turbocharge. And you can continue the conversation with me, Patty Lawrence, on LinkedIn. You have been listening to Turbocharge Your Business and episode 30, Accounting Fundamentals, the Balance Sheet, on IBGR, International Business Growth Radio. I'm Patty Lawrence, and we'll be back after a short break.